The 60-second rule is one of the more controversial elements of Dodd-Frank to hit the books. The rule calls for pre-settlement risk checks by all members who are trading swaps in exchange-traded venues. I'm joined today by Steve Harrison from Imagine Software. Stephen, tell me, what is going on with the 60-second rule and how are folks reacting to it?
Well, it's a rule put into place by the CFTC. It's one of several components of rules 173 and 174, which, as you said, have to do with pre-settlement risk checks that the FCMs have to put in place. The idea is that trade by trade, they're supposed to run some analytics against a client's portfolio to see if they exceed some risk-based exposure that is too much for them to take on. And the FCMs are supposed to say yes or no within 60 seconds whether they're going to accept settlement or not.
And failure to accept means the trade is invalid, correct? If they don't
accept
it
has
breaks.
To,
and there are significant downstream ramifications for that. So this is a major undertaking for FCMs to get right, correct?
Absolutely. And it's going from an extreme where FCMs today, even the most sophisticated ones, mostly do this type of check on a nightly batch cycle. Mm-hmm. So they're going from a nightly batch cycle where the results are normally checked the following day by risk managers to a trade-by-trade, real-time environment. So it's really night and day. And
as a software engineer or as a software provider, what are the challenges in actually engineering a solution like that? I got to imagine that there are significant operational challenges, significant technological challenges, even significant reporting challenges that go with this type of environment.
Yeah, I mean, some of these problem sizes are so large that even the end-of-day batches can't finish in time. Mm-hmm. So when you think about doing calculations at high volumes, at high sophistication of the analytic, it's very challenging. I mean, imagine is spending a lot of time on architecting a system that could actually do both the high volume with the high sophistication. Mm-hmm. There are systems out there which can do either one. They can do a simple analytic at high volumes or sophisticated analytic at low volumes. But this environment is tying the two of them together.
Yeah, and that's interesting because you had said that the CFTC is requiring some risk calculations. That's a pretty broad definitional standard. That's right. I would think that 60 seconds is a limiting factor. So, I mean, the key is going to be how much can you get accomplished in that 60 seconds, correct?
That's right. That's worth something.
Mm-hmm.
Right. The simple calculation, maybe it's a market value of the portfolio compared to what margin they have up against it. But there are so many more risks that could jeopardize the viability of a firm that the FCM should really be checking. What is the liquidity of the instrument that they're trading? If they need to get out of it, how long is it going to take to get out of an illiquid instrument? That's a big one. These other analytics, like a market value check, tell you within this nanosecond, here's the client's exposure.
Right.
But the next second, the market has changed, and so that risk measure only takes you, so far. And so what the more sophisticated players are putting into place are historical VAR analytics. You've heard about Greeks, right? Different factor exposures, stress tests. So not only check the client's limit utilization at the current nanosecond and the current market conditions, but what if the equity markets drop by 10%? Does he blow out his limits? What if FX rates change, credit changes, which by definition
happens all the time.
Happens all the time. And so this nanosecond check is really more of a check the box. Yes, CFTC, we did something.
Have the regulators come down with any specific standard on what needs to be included in the 60-second check? Have they said you have to check VAR, you have to check the Greeks, or are they sort of leaving it open for the market to determine and individual players get to choose?
Right. That you could drive a truck through the definition. Mm-hmm. And it really, actually, there's no there's no specifics around what risk checks to be done.
Is there a competitive advantage for, I assume there's a competitive advantage for the individuals who can do more in less time, correct?
I think what we're seeing is the FCMs are stepping to the plate to do, put a very conservative approach on the definition.
Right.
I mean, go beyond what they could do to impress the regulators that they've got it covered, because they don't want anybody coming in to audit them.
I would imagine, though, that those standards may shift as we move further into this marketplace when people start struggling to try to get volume and flow or start trying to move some of these products, that the individual FCMs will start to fragment into various sort of, large guys maybe doing one, medium-sized or smaller players maybe doing another. Does that pose a challenge for swaps participants?
That's true. I think what's going to happen, and maybe this could work to the FCM's advantage in some case, where they can differentiate themselves by providing, leveraging the service that they're doing for internal purposes, and feed that risk analytic back to the client and giving them, more transparency over their underlying exposures. So you see what I'm saying? We can turn the service back to the client.
For a mid-sized FCM that has to tackle this problem, I mean, what are the financial implications of trying to address this? I mean, this is not an easy solution. These systems, are expensive, aren't they?
Yes, they are. They're expensive. They require a lot of infrastructure. Right? We're talking about, could be hundreds of transactions a second that have to be evaluated to some extent, right? And so you need the pipes to get those trades into the right place. You need the analytics to calculate them. Then you need to compare them against the limits. But then here's another touch point for the FCM to improve on the service. Like I said, they have now some valuable information that they can provide back to their client. Remember, this is something that they used to do at the end of the day and then review the next day. So there wasn't a lot of interaction between the PB, the FCM, and the client.
Right.
And communication with your client is a good thing, right? It
fosters relationships and enhances business.
Exactly. And so if I am now evaluating a client's position on a trade-by-trade basis, I have a lot of opportunity to engage them. Hopefully not because they've reached or breached an intraday limit that I'm now checking.
Exactly.
But they can offer more advanced risk services. Like, hey, by the way, these last several trades have overexposed you, or are you taking on a bet? Do you know that you're actually taking on this bet?
Exactly.
Because our risk analytics, which are happening real time, are showing that you're a little bit overweighted in technology. Did you
Well, it sounds to me like the 60-second rule is an operational challenge. It's definitely a software and engineering challenge, but it does pose some opportunities for the market, and we may allow FCMs to start differentiating their services from their competitors.
That's right. That level of service that they put into play could be as small as the minimum required by the CFTC, or to a level where you differentiate yourself from your competitors.
Well, Stephen, I want to thank you very much for joining us here on Tab Forum. I think we're going to see more about the 60-second rule, and I think we're going to start seeing more about the sort of pre-settlement risk checks. Thank you very much.
Great, my pleasure. Thanks.